There is a $200 billion market hiding in plain sight inside crypto, and most people have absolutely no idea how it works. It is not Bitcoin. It is not Ethereum. It is stablecoins. And if you think they are boring, think again, because they might be the single most important innovation in all of crypto. Today, we are going to break down everything you need to know about stablecoins, how they work, why they matter, and most importantly, the risks that nobody is talking about. Whether you are a complete beginner or a seasoned crypto investor, this video will change how you think about digital money. But before we dive in, if you find this useful, consider hitting subscribe and the bell. We publish deep dives like this every week. Now let us get into it. So what exactly is a stablecoin, and why should you care? So what exactly is a stablecoin? At its core, a stablecoin is a cryptocurrency designed to maintain a stable value, usually pegged to $1. While Bitcoin can swing 10% in a day, a stablecoin aims to stay at exactly $1. Why does this matter? Because stability unlocks utility. Think about it. You cannot run a business on a currency that drops 30% overnight. You cannot price a loan in an asset that doubles in a month. Stablecoins solve this problem by giving you the speed and programmability of crypto with the price stability of traditional money. And the numbers tell the story. The total stablecoin market cap now sits above $200 billion. Tether's USDT alone processes more daily transaction volume than Visa and MasterCard combined on many days. Circle's USDC handles billions more. These are not niche experiments. They are becoming core financial infrastructure. But here is the thing most people miss. Not all stablecoins are created equal, and understanding the differences could save you from losing everything. Let me explain. There are three main types of stablecoins, and each carries very different levels of risk. The first type is fiat-backed stablecoins. These are the simplest to understand. For every stablecoin in circulation, the issuer holds $1 or dollar equivalent assets in reserve. USDT from Tether and USDC from Circle are the two biggest examples. Tether claims to hold US Treasury bills, money market funds, and other short-term assets. Circle publishes monthly attestation reports showing its reserves are held at regulated financial institutions. The key question with fiat-backed stablecoins is, do you trust the issuer? Tether has faced years of scrutiny about whether its reserves truly match its outstanding supply. They recently completed their first full audit, which helped calm some concerns. But trust remains the foundation here. The second type is crypto-collateralized stablecoins. These use other cryptocurrencies as backing instead of dollars. DAI, created by MakerDAO, is the most well-known example. To mint DAI, you lock up Ethereum or other crypto assets worth more than the DAI you receive. This over-collateralization provides a safety buffer. If the collateral drops in value, the system automatically liquidates positions to maintain the peg. It is decentralized and transparent, but it is also complex and capital inefficient. The third type is algorithmic stablecoins. These attempt to maintain their peg through code alone, using supply and demand mechanics rather than actual reserves. And this is where things get dangerous. The most infamous example was Terra USD, which collapsed spectacularly in May 2022, wiping out over $40 billion in value. That single event triggered a cascade that took down Three Arrows Capital, Celsius, and several other major players. The lesson? Algorithms alone cannot guarantee stability when panic sets in. Stablecoins are not just sitting in crypto wallets doing nothing. They have real, practical uses that are growing every day. Use case number 1, cross-border remittances. Sending money internationally through traditional channels costs an average of 6 to 7% in fees and takes 3 to 5 business days. With stablecoins, you can send any amount, anywhere in the world, in minutes, for pennies. For the millions of people sending money home to their families, this is transformative. Use case number 2, decentralized finance, or DeFi. Stablecoins are the lifeblood of DeFi protocols. They serve as the base currency for lending, borrowing, and providing liquidity. When you see a DeFi protocol offering yield, it is almost always denominated in stablecoins. The total value locked in DeFi using stablecoins runs into tens of billions. Use case number 3. Protection against local currency devaluation. In countries experiencing hyperinflation, like Argentina, Turkey, or Nigeria, citizens are increasingly turning to dollar-pegged stablecoins to preserve their savings. When your local currency is losing 50% of its value per year, a digital dollar becomes a lifeline. And here is a newer use case that is quietly becoming massive: tokenized real-world assets. Stablecoins serve as the settlement layer for buying tokenized treasury bonds, real estate, and commodities on-chain. This market has already crossed $12 billion and is growing rapidly. Quick pause. If you are finding this breakdown useful, hit the subscribe button and the bell. It genuinely helps more people discover this content. Coming up next, I will cover the regulation storm that could change everything, the hidden risks nobody tells you about, and practical tips for using stablecoins safely. Stick around. Now, this is where it gets really important, because regulation is about to reshape the entire stablecoin landscape. In the United States, the Clarity Act is working its way through Congress. If passed, it would create a federal framework specifically for stablecoin issuers. This would mean reserve requirements, regular audits, and clear rules about who can issue stablecoins. For established players like Circle and Tether, this could actually be positive, as it legitimizes the space and potentially opens the door for banks to issue their own stablecoins. But here is the risk. Smaller, decentralized stablecoin projects could find it nearly impossible to comply with federal requirements. This could effectively kill innovation at the edges while concentrating power in the hands of a few large issuers. Europe has already moved ahead with MiCA, the Markets in Crypto Assets regulation. Under MiCA, stablecoin issuers operating in the EU must hold sufficient reserves, obtain authorization, and meet strict operational standards. Tether has already pulled some products from EU markets rather than comply. Asia is taking a different approach. Singapore and Hong Kong are creating stablecoin-friendly frameworks designed to attract issuers, while Japan has updated its payments laws to specifically accommodate stablecoins backed by yen. The bottom line? Regulation is coming everywhere. The only question is whether it will help stablecoins go mainstream or strangle them with compliance costs. If you hold stablecoins, this is the single most important trend to watch. Stablecoins are supposed to be the safe part of crypto, but they carry risks that most people completely overlook. Risk number 1, depegging. Even fiat-backed stablecoins can temporarily lose their peg. In March 2023, USDC dropped to 87 cents after Silicon Valley Bank collapsed, because Circle had $3.3 billion of reserves stuck in the bank. The peg recovered within days, but imagine if you needed to sell during that window. Risk number 2, counterparty risk. When you hold USDT, you are trusting Tether to honor redemptions. When you hold USDC, you are trusting Circle. These are private companies. They can be hacked, mismanaged, or hit with regulatory action. There is no government deposit insurance for stablecoins. Risk number 3, censorship and freezing. Both Tether and Circle have the ability to freeze stablecoin addresses. They have done it at the request of law enforcement. While this can be used to stop criminals, it also means your stablecoins are not truly permissionless. Risk number 4, systemic contagion. Stablecoins are now so deeply embedded in crypto markets that a major stablecoin failure would trigger a market-wide crash. The Terra collapse proved this. And with over $200 billion at stake, the potential blast radius is even larger today. None of this means you should avoid stablecoins, but you need to understand what you are holding. So how should you actually use stablecoins safely? Here are 5 practical guidelines. First, diversify your stablecoin exposure. Do not hold everything in one stablecoin. Split between USDT, USDC, and potentially a decentralized option like DAI. If one depeg, the others may hold. Second, understand the reserves. Before committing significant capital to any stablecoin, check the issuer's attestation reports. Circle publishes theirs monthly. Tether now provides quarterly reports. Know what is backing your dollars. Third, be aware of the chain you are on. The same stablecoin exists on multiple blockchains. USDT on Ethereum behaves differently in terms of fees and speed compared to USDT on Tron or Solana. Choose the chain that matches your use case. Fourth, consider self-custody. Holding stablecoins on an exchange adds another layer of counterparty risk. A hardware wallet removes the exchange from the equation. Fifth, stay current on regulation. New rules could change which stablecoins are available in your jurisdiction virtually overnight. What is legal today might require KYC tomorrow. Stablecoins are the unsung heroes of crypto. They are not flashy. They will not make you rich overnight. But they are the foundation on which the entire digital asset ecosystem is built. A $200 billion foundation that is growing every day. Understanding how they work, the different types, the real-world uses, and especially the risks is not optional anymore. Whether regulation helps or hinders, stablecoins are here to stay. If you found this breakdown useful, smash that subscribe button and hit the bell so you do not miss our next deep dive. Coming up next, we are going to cover how to build a crypto portfolio from scratch in 2026, step by step. You do not want to miss that one. This has been AI Unchained. Stay curious, stay informed, and always do your own research.